Greetings, members, one and all of the Salivation Nation. With an alarming statistic, 141 tons of gold flows out of the paper markets. Let's explore. The reason why that's alarming is because it gives us an indication of where the spot price of gold will possibly end up by the end of the year. And it is a metal that we've seen push resistance at around $1,830. And there's some of us who have predicted that gold's going to recapture some of those highs that we saw last year. We're talking about $2,000. That is the amount that I am predicting gold to be this year, but it's looking less likely as we look at the futures markets. But let's take a look at an article here from Kitco that talks about this, especially when we look at the outflows of gold from the paper markets in August, about 22 tons there. Before we continue here, I want to encourage you to hit the notification bell so that you can be apprised of the latest video. And if you could do me a solid favor as opposed to one that is liquid, and that is to gently take your thumb and circle around the thumbs up button. I'm not necessarily asking you to hit the thumbs up button. I'm just asking you to circle your thumb around it. Who knows, maybe you'll be tempted enough to do it without me asking. But regardless, if I could just get you to do that, that would be wonderful. It helps the algorithm. Although the gold price has recovered from its recent flash crash, it was enough to spook investors and drag down overall investment demand last month, according to the latest data from the World Gold Council. In August, gold-backed exchange-traded funds globally saw another month of outflows to the tune of 22.4 tons, valued at $1.3 billion in gold, according to the WGC in its monthly report. It was released on Thursday. Gold faced headwinds early in August as the dollar briefly strengthened and rising treasury yields weighed on investment flows, triggering momentum selling shortly thereafter, the analyst said. Despite a recovery in price in the second half of the month, the initial unexpected sharp early hour sell-off and low liquidity conditions may have unnerved some investors, leading to reduced investment demand. And this year has been quite interesting, to say the least, in terms of that price movement with gold and pulling back. Of course, we saw the same thing, but at a more drastic level with silver. So, to year to date, 141 tons of gold has flowed out of the ETF market. Many analysts have noted that this trend needs to reverse soon if prices have a chance of reclaiming that $2,000 level by the end of the year. Will it happen? Well, as the year goes on, it's less likely to happen. As we move into October and into November, it becomes even less likely unless there is another black swan event or a reemergence of black swan events, which I think possibly could happen, especially with the Mu variant that they're talking about making its way. And again, I talk about that only in relation to how the markets react to such news. And the report noted the ongoing divide in regional gold markets. Major North American funds led the charge with the most significant outflows, totaling 32.2 tons. Meanwhile, European funds saw inflows in August of 9.6 tons. That's pretty interesting arbitrage there between the two markets there. And I tell you, it's, for me, my money is just on buying the physical gold. And I think that we will do well to have that in our stack. I don't mess with ETFs or the paper markets at all. But then again, I really don't dabble in the stock market either. So, report. So noting this difference between the Europe and North America markets is quite interesting indeed. European inflows occurred against a backdrop of Eurozone inflation rising to its highest level in nearly a decade, while regional central banks cautioned that the economic recovery may be slower than expected due to COVID variant concerns, the analyst said. In fact, there's some talk about maybe some things being shut down. Again, I told you about an anecdotal case about an establishment near me that closed down because of this. And there's some talk about local schools even shuttering again, which would not be good. That's going to have a dramatic effect on parents who have their kids in school and they need to find other ways to get them to and from school or educate them and find babysitters and the like. Low-cost ETFs have seen continuous growth so far this year, with holding up 40%. Although the gold market faces a challenging environment as central banks look to reduce their monthly bond purchases, analysts at World Gold Council said they still see some supporting factors for the precious metal, including growing volatility in equity markets and persistently higher inflation pressures. In fact, again, be warned, we very well may see, based off the year-over-year numbers, inflation numbers tend to subside a bit, although I still think it will show stronger than that 2.5% target that the Federal Reserve had initially forecast. I think that it will be higher than that, but some people will see that as transitory, but don't be fooled by that, because I think that it's going to not take long before those numbers start to increase again. And so that a 5% inflation rate in the next quarter after this one is going to mean a whole lot more than the 5% inflation rate that we're seeing about now. Because we had the pandemic last year where everything was shut down, and those types of things with the prices going lower for some things, because of that, is going to have an effect on those numbers moving forward. Nonetheless, the World Gold Council analyst remains optimistic on these gold prices through the end of the year. The precious metal has been unable to hold gains above that $1,830 an ounce level. So their December gold futures last traded at $1,794.20 an ounce, which is relatively unchanged on the day. So let's take a look at the markets as of the recording of this video and see where we are at. And we can see the gold and silver are both up slightly. Gold is at $1,795. It can't quite crack that $1,800 level, but I tell you what, it's much easier for that to happen, I believe, than for silver to break through to 25 again. And the other metals are down substantially. Palladium is down $82. Wow, what a massive drop there, for sure. Might be an opportunity in palladium, although platinum is down too. And but nonetheless, there's where the markets are. And we're even seeing rhodium taking a hit. The platinum group metals all are taking pretty substantial hits here. But nonetheless, gold and silver will continue to do what they do. And that's something we have to take into account. There are going to be dips. There are going to be rises in price. And in the end, it all washes out. And it washes out to wealth preservation. It's the best we can hope for. And that's really what it's about. It's an insurance policy. It's a savings account against economic strife that could come at any time. And really, we are in the midst of the primordial soup of economic strife. It just really has not manifested itself to the extent and degree for many people like to think, because we are essentially have this buffer zone of government stymies, unemployment benefits and the like for many people, and and other factors. But sooner or later, there's going to be some real pain in the economy, especially if one or two other things happen, like the housing market. If it just crashes, or a couple of other things, you've heard the term everything bubble. It doesn't take a whole lot for one or two catalysts to make that everything bubble pop, and everything is up in smoke, and then we're talking about literally an economic collapse, really, in a sense, to the likes we've not seen since the Great Depression, or even greater than that. That's what I really fear. I'm not saying that's necessarily going to happen, but people are obviously not panicking in the gold and silver markets right now because of these prices, and when these prices are low like this, or lower, especially for silver, it makes you wonder. And people get jaded by it, and they're going to move on to some other investment class, and that's just it. They want to make money. They want to try to preserve their wealth through investments as opposed through hard assets like gold and silver, or even any other commodity out there. And it's understandable, especially in this world of digital trading, online trading, instant move with prices moving up and down. But for those of us in the bullion markets, or holding bullion, we're holding this metal, or these metals, to protect our wealth over the long course of time. We are making that move because when we have this thing in our hand, gold or silver, we're paying a premium for it. It's much less likely for us to get that premium back if we sell it the next day, or even a week from there. So that premium we're paying for is the option to hold it physically, knowing that you own it, that you control it, and making that bet that premium will be recovered when prices go up in time. And that is the bet we take, as opposed to dabbling in ETF markets. But it's a more fickle market there, and the outflows and inflows, and that's kind of really what drives spot price. That's why psychology is such a great deal, because if you are in the stock market and you know very little about gold and silver other than use them as hedges, ways to balance your portfolio as an ETF, you're more on a whim to sell off those stocks, those ETFs, those paper representations of gold and silver, those derivatives. For those of us in the physical, we literally have our money tied up in premiums, and we know that if we sell it too soon, we can lose money. And so that's why it involves a whole different level of a strategy to stack the physical precious metal. Let me know what your thoughts are in the comment section below. Pretty interesting news today about this outflow of gold for the month of August and through the year. I'd like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.